Morning, listeners. It's the final session for the week, and this is Almus Market Mornings with Shikhar Garg. Now, we have had quite an interesting day yesterday with Bank of England raising their rates by 50 basis points, echoing the need to further hike rates for the inflation to be tamed. Following the suit and coming into policy tightening action was the Turkish Central Bank. The central bank raised rates by 650 basis point to 15%, which was still a surprise for the market participants as few economists expected a higher rate hike. I mean, even after 6.5% of a hike, there was expectations of higher rate hike. And this is quite interesting to watch how expectations and sentiments influence, because even the Turkish lira was weakening, and it weakened 5% against the USD after this. So, JK, I'd like to hear more from you. Like, what's your take on these rate actions and by the central banks?
Good morning, Shikhar. Yes, central bank decisions came thick and fast yesterday. And highlighting that was obviously the UK central bank going in for a 0.5% hike versus the 0.25%, which most of them expected. Of course, you would recall that I've been saying 0.5% is my expectation, keeping in mind that the inflation is still rising well above other countries, and also the gap to peak rate is as high as 1.5%. Knowing that it is going to peak above 6%. Now, Bank of England, after announcing, they were still hawkish, made it clear that it retained a tightening bias and further tightening would be required. And the economy is doing better than expected, but inflation is still too high, is what they have been saying. Of course, Swiss National Bank, which had its rate deep in negative territory of minus 0.75%, has taken its rate up to 2.5%, and then that is in line with their inflation fighting exercise, and they have not ruled out a further rate hikes if the situation warrants. And Norges Bank also surprised the market, as you said, by hiking by 0.5% instead of 0.25%. And there will most likely be further rate hike in August. So central banks of developed countries remain very, very hawkish and also not relenting on their fight against inflation. Now, contrast this with what happened in Asia. Indonesia and Philippines both kept their policy on hold, and you would also note that the inflation has been falling much more in the emerging market economies, mostly because of the services side. In fact, said that they will go on an extended pause, and there possibly will be a rate cut in 2024. That's a big contrast. Yes, Turkey lira is a standout because they had been following a very unconventional policy of cutting rates even as the inflation was going up. Now, whatever hike they are now doing is just making up for whatever they have not done earlier. And some analysts are out there saying that their rates could go as high as 30%. That is why you saw the Turkish lira, despite a hefty rate hike of 6.5%, actually weakened by 5%. It is weakening even further. Now, apart from this, of course, Indian Central Bank was also in the news because we had our MPC minutes published, and members appeared to be increasingly divergent in their views on future course of rate hikes. Some external members arguing that further tightening could hamper economic recovery. Das was really very cautious, saying that central bank job was only half done, having brought the inflation within the targeted band, but needed to take it forward, looking at the assessment of evolving inflation outlook. And Michael Patra was also saying that holding rate unchanged should not be interpreted as interest rate cycle having peaked. But on the dovish side, we had Jayant Verma and Ashima Goyal, who are cautious about the impact of further rate rises on the economy. Now, apart from the central bank decisions, we also had the second day of congressional testimony by Powell, who said FOMC broadly felt it appropriate to raise rates again this year, perhaps 2 more times. And he was clearly pointing out that strong majority felt a little further to go on increasing the borrowing cost. And headline inflation was mainly falling due to energy prices, but there'd be no much progress on the services inflation. So you have rate rises by developed economies and Fed indicating more rate hikes, and this was clearly a contrast with the emerging market economies. And the market reaction was really very telling. you had the yields going up in US, and then it dragged even the European yields higher. In fact, two-year yields went up by almost 10 basis points in the US, touching the recent highs, and 10-year yield went up by 7 basis points. Now, a lot of focus on the yield curve in Europe as well as Germany. The yield curve remain at the steepest levels for several years, while in the US, the 2 or 10-year yield curve has again steepened above 100 basis points. Now, if that is not a sign of globally led deflationary, or rather recessionary fears, what else could move the stock markets? Yes, that has been in full show in the Asian markets today. Most of the major markets are down more than 1%. Tellingly, Japanese market, which has been one of the strongest performer, has been down more than 1% as well. So I feel even the Indian market, which has been holding up quite well near its all-time highs, is so vulnerable to some swing downside as the global central banks are keeping raising rates. And also keep in mind that investors are focusing on continued draining out of liquidity by the central banks, because their aim is to completely remove the QE amount that was flooded into the market post-COVID, and that's going to create a lot of shortage of liquidity and stress on the asset markets. Definitely on the stocks, European stocks were all lower, and US markets were mixed. Only Nasdaq getting a boost because of the frontline tech stocks. On the currencies, of course, it was a standout weakness in the UK pound, despite a 0.5% increase in the policy rate as against 0.25. It was just a knee-jerk reaction above 1.28, but then it has come back to low 127, and really the investors are now not focusing on the yield or interest rate in the UK, but the impact it will have on the economy. And most consensus is now towards a stagflationary situation in Europe. Now, another standout currency has been the yen weakness in the yen. And now just compare this. Dollar index from September last is still 12% down, but USD yen is down only 6%. Yen's trade weighted index is down to new low. It is at its lowest against Swiss franc since 1979. Now, intervention is again on the minds of traders, but will it be effective without a policy move? Also consider that Japan is not in the currency watch list of the US Treasury, but Japan continues to follow policy that keeps the yen weak. So something has to give in. I feel Japan cannot keep on the sidelines. Japanese authorities cannot keep on the sidelines watching the yen weaken in these circumstances. Perhaps this is also one of the factors in the minds of the traders who are now seeing risk assets holding along is not advisable, because in case yen were to reverse its course, there can be a lot more unwinding. On the rupee, one of the narrowest ranges yesterday, of course, but eventually narrower ranges give way to some good volatility. Looking at the way global markets are poised, we can see one more small bout of weakness in the INR. Obviously, the flows which are in the pipeline will keep upside capped, but definitely 8190 is for the time being proving to be a very durable support. Thank you, Shikhar. Not much on the radar today on the markets, but yes, I think next week we'll see more. Thank you.
Okay, JK, and thank you so much. And I do believe, even though we don't have much on the radar right now, but we have a lot to digest, folks, because as JK mentioned, there has been a lot of central bank actions that we've been talking about. Starting with the central bank action by the BOE, as JK mentioned, and I really like, you were very spot on in your expectations of a 50 basis hike by the BOE. JK, I mean, that was really good. But all said and done, we have observed all the central banks in the developed nation have remained hawkish in their stance against the inflation, while there has been some contrast if we have to talk about majority of the developing nations, with the likes of Indonesia also pausing their hike regime. It was the Indian MPC minutes which were released yesterday, and the members were divergent in their views, and it was also observed And a very quite interesting statement was released by the Deputy Governor, Mr. Michael Patra. He mentioned that the pausing of rate hikes may not necessarily mean that we are peaking in the rate hike cycle. Now, this is something that we need to note. And as a response, across the global financial markets, we have seen the equity indices lower. Majorly, all equity indices were, viewed lower, and the financial market participants have now started seeing stagflationary situation in majority of the developed nations, and they're now focusing on these stagflationary situations rather than focusing on the yields and other things. One last bit I really would want to see how things go about is what you mentioned, JK, about the Japanese central bank's actionables. Now, we have seen Japanese central bank keeping quite a lot, even though there has been significant inflation, and they've continued to weaken their currency, which is just, I think, adding on to the inflation that we see for the Japanese nation. And any action from the Japanese central bank would come with a lot of response by the market participants. So it's time to see how things go about in the coming few days. That's it for today, folks. We shall come back again next week with another round of updates. Thank you so much for listening.